In 2011, I approached David Gong and asked him to consider joining our firm to oversee a portfolio that purchases high-growth companies in local currencies in developing countries, including China, India, Malaysia, Brazil, Poland, Peru, Turkey. David was and is one of the most experienced emerging markets money managers in the world. His credentials include having served as a compliance attorney for the Securities and Exchange Commission after graduating law school. Afterwards, he went back to business school at Stanford and graduated and was recruited by T. Rowe Price and worked as a domestic equity manager. T. Rowe Price was one of the companies that was early on the curve in recognizing what was going on in the emerging markets, opened an office in Hong Kong in which they collaborated with the British merchant banking firm Robert Fleming, and they asked David to go and oversee the Hong Kong office of Rowe Price Fleming, where he did for a good part of the 80s. Afterwards, David moved on to Singapore and worked for Ancar Limited and managed, which was a consortium of Asian banks. I told David when I approached him that I felt that Brad's AdStar system was finding great companies in his markets well before other institutional investors who relied mainly on sell-side research. He agreed to visit our firm, and after 6 months of testing, modeling, number crunching, we opened the new fund. Since that time, David has won numerous institutional money management awards, including the #1 manager from AI Hedge, Barclays Hedge, PSN Informa, and other large institutional databases. Given China's ever-growing influence on world markets, I thought it would be helpful to bring in David and offer his point of view as to what is going on in China, what the risks are, and what the potential for a spillover effect into the developed markets, primarily the United States, might be. David Gong.
But thank you, Bill, for that introduction. Actually, in planning this, the actual topic was, I think that was sent to you, is what is really happening in emerging markets and China. Will they take the developed markets down? So in a sense, I was approaching this with trying to answer the question for you, China, is the sky falling? And I guess to jump to the conclusion that the sky is not falling, but let's touch upon some of the issues that have lent themselves to the tremendous amount of volatility in global markets and particularly emerging markets over the last 9 to 12 months. Now, there have been a number of factors that the financial press has identified for why markets, particularly emerging markets, have been behaving so badly. I'm going to touch upon a couple over the next 20 minutes, and hopefully that will lead to discussion, a deeper discussion into each of those. As I look at the reasons why people have been extremely concerned about global markets, number one is slower global growth. All through 2015, I've watched and I track economic forecasts for growth for 2015, 2016, 2017, and about every couple of months the numbers notches down, a couple of basis points and so on, and usually the culprit is what is happening in China. So we will look into what is actually happening with growth in China. Other factors that are cited quite often is a very, very sharp decline in the price of oil. And as you know, the price of oil is, people look at that as being something that is critical to growth in emerging markets, because there are a lot of emerging markets that are primarily commodity producers and in particular oil. But maybe they're missing that for every loser in that equation there is a winner. So we'll look at that as well. Finally, I'd like to talk a bit about the sharp correction in the Chinese local stock market that occurred in June of last year, and then following that a couple of months later, a start of a round of devaluations in the Chinese currency that really spooked markets, spooked currencies, and I think has a lot to do with the volatility in the market. So let's first turn to economic growth. So as I said, in looking at kind of recent International Monetary Fund projections, they currently estimate global growth for 2015 at 3.1%, and that will increase slightly to 3.4% in 2016. Looking behind those numbers, if you look actually at the group of emerging markets and emerging economies, those are projected to increase 4% in 2015, 4.3% in 2016, and 4.7% in 2017. And even if you look into deeper in those numbers, in fact, India, China, and many parts of emerging Asia, those parts are still projected to grow at a pretty robust pace. But that's just looking kind of at the next couple of years. And what I wanted to show you in this chart here is, if you step back, if you really understand where is growth going to be happening in the world over the next 15 years, 30 years, and so on, it is really going to be coming from what we term as emerging markets. And you can see in particular the economies of China and India are really projected. And you can quibble on maybe what year this really happens, but it is, I think, without question, that China and India, on the growth rates and really their populations, that over the next 20 years, certainly China is going to surpass the United States, and then looking out another, into 2060, even India will have a larger share of global GDP than the United States. So again, the picture here is that there is slower growth next year, and for reasons which we'll go into. But indeed, if you're looking for growth in a portfolio, you really need a component of these companies, well-managed companies that operate in these markets. Now, and this chart also, this more or less again it underscores the same point that if you look back, in 1950, China and India, they had a very, very small portion of the global economy. Then looking at 2050, you'll see that China, India, Brazil, and so on, they become very, very large components of global growth. Now, probably as important as kind of getting a handle on what are growth projections for China, it's probably more important really for everybody to understand the nature of the engines of growth for China, how they've changed. And this chart really shows, I think, one of the more important changes that's occurring. China, even back in 2005, they are shifting their economy away from a manufacturing-driven economy to one that is more service-oriented. And that's actually, it has very, very important implications on their banking system, on their currency rate, and so on. But we'll dive into that deeper. But if you just take a look at that chart, you want to compare it to, for example, if China right now is maybe one back, or maybe this will actually show it, but both of them do. So China right now, 48% of the economy is attributable to services. In the United States, it's 80%. In Canada, it's 70%. Even in India, it's 58%. But so that's really kind of, in a sense, as economies mature, you should see a shift away from manufacturing, because that will usually go to places where there are lower input costs. And so China recognizes that, and so they have been, over the last 10 years, been moving towards a service industry. Now, not only that, and again, probably very importantly to understand, is not only are they shifting away from manufacturing to services, but indeed they're actually shifting away from an investment-led growth strategy to consumption. And that was announced in the latest 5-year plan of China. They've been embarking on it for 5 years, and that's really causing significant, I think, changes in the way that the Chinese leadership is moving their economy. Now, when you have an economy that for so many years was really more investment-based, they gave very little incentives for the Chinese population to actually spend. So even though I think they've been relatively successful in moving towards a service-based economy, the consumption story will take a little bit longer. And again, I see that the move to services actually is really an important piece of that strategy to move towards consumption. The service economies actually provide more jobs. Service industries are more labor intensive versus the manufacturing industry in China. So there's job creation. Also, service jobs in China will have there'll be a higher wage attached to service jobs. If you look at the big shift in China is from the rural to urban. So essentially, urban service wages are 4 times of rural wages. So again, that'll be an important piece of the consumption story. But finally, really for China to successfully move to consumption, they have to solve safety net issues. The Chinese are not really, historically, there's really been no pension plan for them, for most of the people, particularly nobody in the rural economy, certainly. And as well, there's a very somewhat, in the beginning, very inefficient healthcare net. The Chinese leadership is addressing both, so I actually am somewhat hopeful that with these pieces in place, that eventually they will be very successful in moving the economy to where consumption is the important driver. Again, very important. And really the reason why I'm hopeful of that is just the mathematics of the middle class. So I think we have some middle class, maybe this is just pure population, but the next slide, I think. So those of you who actually are repeat visitors here, we've talked about how important the middle class story is for growth in the emerging markets. I mean, right now, you have very, very large and growing middle class groups in China, India, and also what I consider the ASEAN 5, the Association of Southeast Asian Nations. And even right now, in fact, I have I think Credit Suisse recently published that for the first time, China's middle class of 109 million people exceeds the 92 million middle class Americans. So that was actually back in November. But I think really it's the again, and this chart kind of underscores that. If you go out to 2030, 93% of the global middle class is going to be from the emerging markets. And why is that important? Because as people get into the middle class, that's usually when there are defined consumption trends on property and automobiles and travel and movies, and I mean just essentially that's the sweet spot for consumption. So even if near term people are a little bit worried about growth in 2016, 2017, really step back. The big picture is this part of the world, they're getting to the middle class. It'll be by far the largest middle class in the world, and they will begin to consume. Now, I think I did mention how oil had been, essentially with the collapse of oil prices, they peaked at $150 a couple of years ago, and now recently in January they fell below 30. That had very unsettling impact on investors who a lot of debt investors as well as equity investors in emerging markets, because there's this kind of association that when oil prices fall, so many of the emerging markets also are losers in that equation. And indeed, the big losers include countries like Nigeria, Iran, Russia, the Persian Gulf countries, Mexico, Venezuela, as well as Norway and Canada. But really, they're the losers. But there are some significant winners in that equation. And by far, the biggest winners are China and India. I mean, a fall of $50 a barrel from where they were before, even 50, now it's actually 100, but for a $50 per barrel price drop really translates into hundreds of billions of dollars of savings for China and India. As you can see, China and India are very, very large consumers of oil. And it's really happened at an important time for both countries. For China, even though we can definitely see their exports slowing, the fact that their oil bill has gone down so dramatically, it means that even with slower growth in exports, their trade balance is still growing. And that's really allowed the Chinese some breathing room to begin to really, to allow for this really slow transition from investment growth to consumption growth. And there's really no precedent for a country to actually make that kind of change quickly. So that kind of change from investment to consumption, it will take time. The Chinese leadership is patient. They know at all costs they really want to keep political tranquility, and so they know that that it's not going to be an easy process. But I can read the leadership as they're committed to that change. For India, it's also come at a very critical time, and maybe there's even a better story about India. And India is a country with, again, a very large oil appetite, kind of plagued by trade deficits and particularly fiscal deficits. And the oil dividend for India has really allowed them to keep inflation down, to actually have, somewhat attractive foreign reserve buildup, and it's really given this new Modi government the ability to focus on really the critical economic reforms that India has to go through if they're really going to continue on a growth path. And right now, India is likely to grow about 7.5% in the coming year. And again, a lot of that I really attribute to this oil dividend that's really allowed the Indian leadership to keep interest rates low and keep inflation contained. Another beneficiary of this oil dividend is actually Indonesia. So Indonesia, which historically was an energy exporter, more recently has really turned and they become an energy importer. And so lower oil prices really have allowed the Indonesian government to do away with very costly fuel subsidies that really had a very negative impact on their fiscal position. So with the oil dividend, their fiscal situation looks better, their external trade position looks better, and the Indonesian rupee is one of the stronger currencies so far this year. So on balance, I really think that obviously the oil exporting countries, they're probably breathing a little bit of relief with a slight rally in oil. But I think that our forecast is that there will not be a real sharp rebound in oil if it stays around here. I think that in a sense this stability will actually be a positive for the emerging markets. And as I look at China, what they did, they were heavy buyers of oil in December and January as prices really crashed. I think they doubled their strategic reserves. So it gives you a little bit more insight into how the Chinese look at the oil changes in oil prices and where they decided it was a good time to come in and build up their reserves. Finally, before turning to individual companies, I want to make a couple of comments on the Chinese stock market crash and the issue of currency devaluation. Because really, if you kind of stay up and watch CNBC or Bloomberg News, there's about every day someone's forecasting something really terrible happening in the world, kind of caused by the Chinese stock market and a massive devaluation at the level of the 1997 Asian financial crisis, which I think, look, everybody has to be concerned about the buildup of debt in China, but there's so many differences between 1997 and the Chinese situation. I discount greatly that eventuality. Now, as you know, the Chinese stock market had a significant crash in June and then August and even more recently this year. But you have to realize that essentially the Chinese market had appreciated about 159% before the fall. So in reality, I look at it as just a much needed correction in an overheated stock market. it's a market that, very unlike our market, is really dominated by retail investors. There are virtually no true institutional investors that exert some discipline on these kinds of sell-offs. And so you really had not a stock market, but really almost a gambling casino. And so, when things begin to move one way, they really move quickly. The important thing to remember is the average household holdings of Chinese equities from an average household is very low. So you really have literally a smaller number, but very, very large individuals that play the market. And so they own the market, they buy, they sell it. It has literally almost nothing to do with the real economy. So my message to you is that a fall in the Chinese stock market or a rise in the Chinese stock market is not reflective of what's really going on in the true underlying economy. Now, 2 months after the stock market crash, China happened to devalue their currency. And so a lot of people wanted to put these things together. Oh my gosh, Chinese stock market falling, is it because of something wrong with the economy? Well, look at the export numbers, they're declining. Is China going to devalue to boost their export sector? Again, if you go back to what I was telling, what I think about what's the change in the Chinese economic growth engines, they're moving away from exports, they're moving towards services, they're moving towards consumption. So I don't believe that the Chinese have any intention of really using their currency as a competitive weapon to really help their export trade industry. As indeed, because of the oil dividend, even with slowing exports, actually their trade gap is growing. The history is that kind of prior to about 2004, the United States just kept on banging on the Chinese that they were undervaluing their currency and they were being bad guys and they had to do something. So the Chinese, since about 2004, they more or less agreed to kind of stay pegged to the US dollar, which has led to about a 60% effective devaluation, overappreciation, of their currency versus actually their trade-weighted components. So they were losing ground to Europe, they were losing ground to the Japanese, they were losing ground to the Koreans, Thais, you name it. So I actually think that what happened is really now the Chinese have decided to move away from a peg to the US dollars to more in line and having their currency move from this point forward more to their trade-weighted basket. Not only that, the Chinese really want to see the renminbi eventually be freely convertible. They really want it to be a reserve currency in the world. They need to bring stability to that, and part of that will be a very gradual devaluation in the currency. So again, I don't think that the Chinese leadership has any intention of using devaluation to boost their trade. I think if they want to be part of essentially the foreign reserve currencies and part of the IMF reserve, special drawing right reserve, they need to behave very responsible as they manage their currency. And I see nothing wrong for them to really peg that basket to their trading partners versus the United States. But lastly, as I had mentioned before, because of the buildup in debt and because of these devaluations, there's some very well-known hedge fund managers in the countries that have been very public about they're examining the debt buildup, and their conclusion is that indeed China will have to have a large-scale devaluation really to kind of pull the Chinese out of this low growth scenario. And the Chinese are still forecasting their growth to be about 6% this year, 6% the next year. And although indeed, it's there are a lot of critics about economic numbers coming out of China, I kind of believe that everybody should be looking at these macro numbers out of any country and having questions about them. It's as economies change, as we go from old manufacturing or agricultural statistics to modern economies with a lot of very difficult to track and understand growth rates in services and the internet economy. I think that the criticism of Chinese growth numbers are exaggerated. I would say that you're probably plus 1% plus minus on any kind of given broad number, but put that in perspective. That means I really do believe that China grows something like 5%. But even that masks something that's more important, that China, with that $1 trillion economy, is made up of many $1 trillion industrial sectors, or economic sectors. Some of those are growing very, very rapidly. As we look at things like, the internet economy in China is growing very rapidly. Retail sales are actually growing much faster than, stated GDP. Entertainment. So you have a lot of the new economies of China that are larger than many countries growing very rapidly. And companies engaged in those parts of the economy are doing very well. The sectors that are more cyclical, if you're involved in mining coal or fabricating steel, you're in a recession, you're in a depression. And even though companies involved in those activities, because they're deep cyclicals, we're seeing now that really across the globe, the deep cyclicals are beginning to catch up. So far this year, it's really been away from growth into cyclicals. So that's kind of a signal where the mentality is right now. But in China, really, if our mission is to find growth companies, we still find plenty of growth companies, but they're serving the consumers. The Chinese automobile industry is the largest in the world right now. I think they manufactured 24 million cars this year. Much more than the United States. And you really think back, back in the early 90s, there might have been, 4,000 automobiles in the entire country, to now where they're selling 24 million. That's the power of a consumer segment that really is growing. And so, as we look at China, just really realize that it's such a big, diversified economy. It gives it strengths that I think allow it to be resilient to kind of the pressures that some of these the hedge fund manager pointing why they think there'll be a 1997 event. In general, Asia and China, you're looking at much better foreign reserves kind of across the region than I saw in 1997. You see much more diversified economies, and you see much stronger banking systems in most countries with much higher capital adequacy levels. That doesn't mean China's out of the woods. Clearly, I am concerned about the buildup in debt. China will likely have to figure out how to basically deal with all of the bad debt in the economy, but I don't expect, they won't do a 1 year, let's clean out the stables and have a one-time shock. The Chinese leadership doesn't act that way. It's more likely that they will. It'll kind of look a little bit like Japan, but it's still a command economy. So they will figure out a way to eventually recognize these losses at a measured pace and grow the economy at the same time, because the Chinese leadership will be playing a 20 or 50-year game rather than a 1 or 2 year game. That's my timer, and I'm done. So again, I invite anybody really to, if anything I've said kind of sparks a question, I'll be around all evening. I really would love to meet each and every one of you and really talk about anything that I've raised today. Thank you.